I guess I'm talking about mitigating risk. So thanks 500 Startups for having me here. I'm a partner at Gunderson Dettmer. We're a venture-focused law firm here in San Francisco, Redwood City, Los Angeles, New York, now Beijing, and Boston. So the 500 folks asked me to, or we sort of decided I'd talk, and we talked about some topics. And one of the things they actually asked me to talk about initially was, gee, Josh, you see lots and lots of deals. Will you talk about Series A terms and Series C terms and innovations in Series C terms? And initially I thought there's a lot of that information out there already, and I wasn't that inclined to do that, but at least as a nod to that initial request, we went back, we took some of the data that we received through all the deal flow, both on the investor side and the company side. We crunched that over the last several years. We did something different, actually hired a designer to put that in a sort of a compelling format visually to at least help with. And what we came up with, I think you'll find kind of interesting. What you see here, there are lots of companies being formed, more than ever before. And that's there's an axis there. And then that one is the valuations of these companies that we're seeing also. The hockey stick to the right shows the upward trend of those companies and valuations and numbers and everything. But I mean, this theme is something that we all kind of know in this room. You're seeing deals a lot. The fact that we have a conference of seed investors and A investors and sort of folks that are out here. The fact that I spend half my days sort of now looking at new companies that are inbound for me. It really is representative of this market. And so what we're seeing out there, of course, is a lot of sort of good and bad trends because of this. And one of them, of course, is the Series A crunch. Different folks have different feelings about the crunch. Dave has some particular feelings. It's out there, though. We know it's there. We're going to talk about acqui-hires later. I think Mike's going to kind of talk about that a little bit. I spend a lot of time working on acqui-hires and planning for them and working with the companies to get through them. But there's a darker, seedier side of the world when we have to deal with a Series A crunch where, we can talk about cause and effect, but certainly we're seeing lots of seed and A companies raising money at probably valuations they shouldn't. It's a hot deal. They're going to come in and they're raising at a 20 million cap, right? You've seen a few of those, or even higher, or uncapped. They raise $1 million, and then all of a sudden they go out for a Series A, and maybe they even raise on that and a slight uptick. And then they get to a B and they realize, oh shit, we don't have investors that are willing to kind of look at the numbers that we've actually put together. We don't have the right team. We don't have the right product. We've actually changed our model a couple times. Now what do we do? That's a problem. And maybe you soft landed with an acqui-hire, and that's kind of the best of all worlds. Everyone gets to say, hey, we found a home for the team, and maybe the investors get some of the money back. But that's not always the case, right? There's sort of dire results out there that we all try to skip over. And I think it's been sort of an interesting trend, and back in 2002 and 2003 and 2001, and then again in kind of 2008 and 2009, sort of following relatively catastrophic times in our market, I spent a lot of time doing, shut down the companies, dissolutions, right? And the other one kind of recaps. Hey, we still have something we think we can do here. How can we kind of keep the company going, reset the trigger on everybody on ownership and preferences, and sort of move forward? I'm now seeing that again. I mean, the last sort of several months in particular, first sort of last year and the year before was these acqui-hires, sort of very small sales and maybe some shutdowns and dissolutions. But now I'm doing a ton of recaps, and they're with companies that have only raised $1 million or a couple $1 million or sometimes a little more. So it's a little sort of different than I was used to seeing in sort of past times that were sort of post those bad economic times. So this is kind of what I talked about. That's kind of the outline. And the end of the world slide is not meant to be my sort of Sequoia, rest in peace, good times. I mean, I think we're still in a very good market. There's still lots of deals to be done. We can have a sidebar about, gee, how can we press companies to be a little more sane on valuations? I can't do it. When I talk to them and I say, boy, maybe you want to raise it a 10 million cap. That feels pretty good too. Why would you say that, Josh? You're on the investor side, right? I mean, there's a lot of pressures out there for these guys, but this is what we're seeing. And these are all flavors of sort of the same thing. I have a bullet point on asset sales. I'm not going to spend too much time on that. I mean, that's, if you've done any of these acqui-hires, most of them are being done as an asset deal. I'm talking about kind of the worst side of that is you've gotten through and you realize you don't have a partner that really wants to acqui-hire the company. And so you're actually selling off the bits and pieces. Wind downs and shutdowns, that's really a theme for sort of all this sort of planning is really what I think about there. Recaps is at least the glass half full. And dissolving is a kind of a quick note. That's probably under the subheading of wind downs. But the whole idea of this talk for me was, look, if you haven't seen this already, you're gonna be an investor, you're gonna be on the board, you're gonna see a lot more of these. I mean, there's just too many companies raising sort of money right now, and not all of them are gonna get through, and not all of them can be acqui-hired, and not all of them sort of can find that soft landing. So let's go through this. It'll be boring and terrible and painful, but take your medicine, you'll thank me later. So let's start with asset deals. And I'm not going to, again, go through all these things, but basically asset deal, you're not buying an entity, you're not buying stock, you're literally buying the assets of the company. And so the good news with that is if you're a buyer, great, I take what I want, usually just some of the assets, and maybe some of the team comes over. But I'm not going to take some of the liabilities, those stick with the company unless they're sort of strategic to the assets I've taken. Right? And if you're a buyer also, it's great because you don't have to worry about sort of the administrative approvals, stockholder approvals, and sort of other sort of paperwork that we usually have to deal with. If you're on the other side of it, you're the seller, well, gee, now I got to worry about I have an entity that's left behind. Well, how do I deal with all the stuff of shutting down? And we'll talk about some of the pains of that in a second. Boy, what about those liabilities are left behind with me? Do I have to worry about getting consents now because I didn't actually buy the entity? I've got kind of key contracts. I have to go talk to partners and get them to approve that. So there's enough to go through here, and that's sort of I could do a whole separate talk about asset deals. But the point being is, in a dirtier world, you get past the acqui-hire, how do you separate your IP assets? And that's when you really start thinking about this. I didn't find that partner. I didn't find an acqui-hire partner. So you think about it and you say, okay, well, I've got content. Maybe you have a content business. I've got content over here. I've got an interesting platform over here. I happen to develop a small patent portfolio. Well, strategic partner A wants to come in and buy the patent portfolio. But gee, the background platform actually uses bits and pieces of that patent. So can I get a license back from that buyer? Well, the buyer doesn't really want that either because they want to make sure they have the protections going forward. So there's a lot of nuances that we have to kind of get through thinking about that. But these are sort of things more of, keep these in the back of your head, make sure you're talking to counsel, how will this work out strategically, and can you actually go through and sell the bits and pieces to at least get something back? Now, let's talk about recaps, because this is kind of the more interesting part of all this. Recaps are sort of like I said, the glass half empty. And it's really in a world where you say, things have kind of gone the wrong way. Maybe some of the team has left. We talked about product problems. Boy, maybe you weren't paying as close attention to the business as you would have wanted, and you realized the burn was a little out of control, right? That happens too. All these problems kind of come and you realize, all right, we built something that's actually kind of interesting, and there's a really dedicated team that may be willing to stick around and do this. And we still believe that there's something there as investors. So, we're all looking at each other and saying there's a chance, and we're committed to doing this. And the problem is you've got a bunch of investors out there already who put in money, so you've got preference sitting out there. You've got an old team that's not around. You've maybe got some other investors on around. You've got a weird cap table now. If all you're really going to do is put in another $1 million on a $2 million sort of new valuation, you want to reset everything. It's complicated. You've got a lot of sort of constituencies to deal with. So this is the classic recap. And before I go into sort of some of the key things for the recap, I should sort of note on the side, in the old days for me were sort of late 90s, but you'd see actually contractual provisions called pay-to-plays. And some of you probably have heard of that. Probably some of you have been through those. They're less common today because we've been through relatively good times, and we also learned some lessons during those bad times. One of the lessons of that was putting in place a pay-to-play sort of at the very beginning is nice to have as a backstop, but two things. It may not actually address what you're trying to solve for at this time, at the present day. And the second thing is, if you don't have precise mechanics in those pay-to-plays, you can't really enforce them. And so it becomes an enforceability issue. We ran into a lot of those just that were poorly drafted. Folks didn't understand them, and again, sort of problematic. So now we are in a place where I think not anyone's going to have that pay-to-play. So I'm assuming there's no pay-to-play. You've just got sort of normal Series C docs or whatever your sort of financing docs are. The key here is we're trying to solve for two things: ownership and preference. And what I kind of refer to as a preference overhang. And you're going to have to work through a lot of modeling because you're thinking, okay, how much money am I going to put in this company now? What's my ownership expectation? How can I get the other guys that are around the table to put up some money? And that's the carrot, and kind of what's the stick that we're going to sort of enforce on them? So usually this is sort of a 5-step process, and it kind of all amorphous. But the idea is you have to get your syndicate around you, get those other investors around you, and get them on board with it, basically the first thing. And what you do is you trigger what we call the auto convert all your preferred stock to common. Voila, you have no preference left. Everyone's common stock. Great. Well, now what? We got to raise that round. So you close that round on those economics. People actually put the money in, you buy your new preferred stock, and now you've got a cap table that looks like one class of preferred, one class of common, very clean. But you had that carrot we talked about. And so we say, well, gee, you guys did put money in before. How can we incentivize you guys to come in on this? Well, we'll preserve a portion of your old preference. So we'll pull through, or we'll take that old preferred stock and exchange it for some new preferred stock with less preference, but at least you're preserving some portion of it. And then you say, who's stuck? Well, we got the investors in now, we got the old investors who played along or who didn't, and now we've got a new team going forward. So now you got to figure out, you got to get them some stock. That's great, but gee, the ownership is still going to be screwed up because you have all this old stock sitting out there from the old preferred and the old team. So we squash it down. We do a reverse stock split. And again, these are all numbers you have to figure out, and this is sort of why the modeling becomes so complicated. You figure out what that reverse stock split is. And then lastly, once you've done that, you go issue your stock to whoever you're supposed to be sticking around the team. So I mean, that's a very sort of high level, and I mean that in the deepest sense. I mean, there's lots of documents and lots of considerations. We'll talk about a few of them. You know, the self-plug, gee, talk with the company, talk with your own counsel, talk to the company counsel. You know, are you on the board, right? Are there considerations you need to consider there? Are there fiduciary obligations? Is this fair to everyone you're doing this with? What else is out there? You know, as you're going through this, you can kind of, cut and paste this somewhere along the way and use this as a little shorthand and sort of, has the company done the right things to get to this point? And did you actually go out and look for new money, or is this sort of something that's being led by an investor when no one actually sort of tested the waters? And the good news is, if you don't find a new lead investor, that's a great fact, because then you say, guess what? There wasn't a lead investor, but this is the best we could do, and we actually couldn't sell it either. And I offered to everyone else. I said, hey, old investors, why don't you come in and play along with us? And I gave them a reason to do that, and I talked to them about that. And maybe you find out if you have a board at that point that sort of has independent folks, you create a special committee. I mean, there are, sort of go down the list, there are ways of sort of doing that. And I didn't mention it in the previous model, but price-based anti-dilution, let's add another variable to that model you were trying to create, right? You now have a down round situation, lower than your previous round or two. You've got added dilutions, they're going into a crazy iterative calculation, spreadsheets are blowing up, lawyers are getting frustrated, you guys hate us, we don't know what the model's doing. It is a very messy, complicated process. So, gee, if that's so bad, Josh, is there an alternative? I think the answer is kind of. The alternative really is a convertible note. What the recap solves for is truly the idea of, I want to go forward and build on this company. This is a platform I truly believe in, and we're going to go for it. The note doesn't quite solve that because you've still got preference out there. You still have ownership issues. But if this ends up being kind of a, we don't really know, and we think we just need to bridge the company to get a deal done, which is maybe a strategic deal or an acqui-hire, that's where the notes come into play. Layer them on top of the preferred stock. You're just a creditor. You stand in front of all that preference, right? And you get your sort of, the carrot and stick is built into kind of a multiple, meaning you sell the company, you don't just get your money back, you get a 2x or maybe even a 3x. And that becomes all of a sudden the carrot and stick for the old investors. Hey, play along this bridge, you'll get some more money out, right? But again, it's investment decisions, you'll see that, but it doesn't solve the problem for, we want to continue leveraging that. So I put lots of big bolded font, and my marketing team hated it because they said it's not our standard procedures apparently. And I promised there'd be some interesting context to all these things, but the prepare is really one of the best pieces of advice I can get. And it's really meaning, you have to have someone who's close to this. A lot of the times they are sort of younger entrepreneurs at the seed or A stage. And they may have a great product, and they may have actually been through YC, they may have been through a couple products and things, but ultimately, they may not know numbers. And so you gotta get in there and crunch those numbers, understand the assets and the liabilities out there and who you have to pay off, right? And you gotta remember to do all that, when knowing that, gee, it's not a going concern anymore, this thing's gonna die. And oh boy, I don't have kids, by the way, and I still love Thomas the Train, and I like that he can swear. It's just disturbing. Personal liability, right? You get in these zones of insolvency, you can be personally liable, right? And so, let's just go back to that for a second, because that's really, the next few slides, just remember this. That's why like zone of insolvency, personal liability, Thomas the Train says, oh shit, that's important. But the reality is if you're on the board, yeah, you have a lot of considerations to take into effect, right? And there's a short list there. The easy ones are kind of what we call statutory liabilities, salary, accrued salary, PTO, maybe even severance. There's some sort of non-obvious ones, but again, talk to your investor counsel about that. Now we're getting to okay, now we've gone through all that. Maybe we sold some of the assets. This is sort of all part of the process of how do we get there and actually just cause this thing to kind of go away at the end of the day. And there's ways of getting there. I talk about self-managed, which means maybe the management team sits around, or maybe one of the board members or an investor runs the process with them. You can also hire folks like Sherwood Partners. I think accounting firms are starting to do this now. It's just because it's becoming so common. And ABC is really a nicer flavor of a bankruptcy filing, basically. Right? These are all things that are out there at your disposal. And then the friendly foreclosure, which is, either the self-managed or the friendly foreclosure is probably what you're going to see in this market. And all that is, we couldn't sell anything. We talked about venture debt before. They're secured creditors. We owe them a bunch of money and we can't pay them off. Well, we're going to hand you the keys to the car. It's all yours. Go do with it what you want. And remember, those guys, they don't want to do that because they know you guys know the companies better. The entrepreneurs know the company better. You're going to have a better shot at selling that for a higher value and getting more of their money back. But if worse comes to worse, here's the keys. Thank you, WTI, SVB, so on and so forth. And then we talk about, I'm not going to go through any of this. It is terrible. But again, take this checklist. It's only a short portion of, what do I need to look at when I'm doing a wind down that I care about? And what do I have to get ahead of, right? Lots of nuances there. So I talked about prepare, communicate. I talk about stakeholders, right? Start the conversations early. Talk to WTI or SVB. They'll be on board with the plan. It's in their interest to be on board with the plan. Talk to your stockholders and make sure you have the right folks around the table to kind of get something done. If you got bridge note holders who bridge the company, they're going to have to be part of this, and that might be you also. You have to worry about your employees, who's sticking around. Can you keep the morale up? Who can be there? And then this is worth on your own time, but again, fiduciary obligations. But one key thing here, and I think people confuse this, you're a stockholder, and that's all you are. Who you look out for? Yourself, no one else. You don't like the company that's coming in and buying the company because of their logo. They screwed you in a previous deal. You're feeling agitated that day. I'm saying I'm not going to approve the deal. You have the absolute right to do that under Delaware law. Oh, you're on the board also? Your personal opinions don't matter anymore, right? You got two hats. And so those are sort of the key considerations there. And the other one is sort of creditors. Sometimes people talk about, do I owe a fiduciary obligation to creditors? Short answer is not really. But they're a stakeholder. I talked about this is all part of a comprehensive plan, so you're not going to ignore them. It doesn't matter. Just maximize that enterprise value the best way you can, basically, and keep the team involved, the stakeholders involved, and communicate. Skip over one more because I'm getting short on time. One quick note on dissolution. Filing a certificate of dilution does not end the company's life. It starts kind of the wind down process. But make sure you got some things to cover there. And that's kind of a bunch of bullet points. That's me. That's our firm. We do lots of deals, right? There's some cool numbers. More importantly, we've done a lot of deals for 500 startups. I probably have time for one or two quick questions before I really get kicked off. Just one. I thought you were the question. I got excited, Sean. Yes, question. Anything exciting? Thomas the Train, trivia? Thomas the Tank Engine, also good. Thank you. See, I don't know.
Do you move companies from overseas here? Can you tell us a little bit, when companies from Brazil comes here, what do you do?
Oh, well, I mean, internationally, sort of a separate topic, but inbound companies, we see that all the time, basically, and there's a lot of considerations on what stage of the company, where are they taking money. The complicated part of that transaction is outbound. They're going to get taxed by the outbound sort of taxing jurisdiction, and how do you sort of mitigate those tax risks? That's another, well, more than 20-minute conversation, that's for sure, but happy to talk afterward. Thanks, folks.
Thank you.